This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, in our first introduction to corporation tax in the previous chapter, we saw how it was that we would put together and present that corporation tax computation. We saw that the major component was the trading income assessment, and that would involve probably two major exercises, two exercises that we're more than familiar with by now. That is the adjustment of trading profit process from the accounting profit on the businesses, here for us, here the company's statement of profit or loss, and from the additions and disposals and other information provided, put together the capital allowances computation. What we also learned in that first chapter on corporate tax was that we prepare a corporation tax computation and we carry out that process of adjustment of profits and capital allowance computation. We prepare it for a chargeable accounting period. And what we learned about the chargeable accounting period was that it is usually the same as the company's period of account, the period for which the company prepared its accounts. It's year end, it's year end, it's year end, etc. etc. That would become then the company's chargeable accounting period. If the company had a short period of account, maybe when it started, when it finished trading, or as a means of changing its accounting date, not a problem. The short period of account becomes the chargeable accounting period, and we prepare the corporate tax computation for it. The only time we had a difference, a discrepancy between the period of account and the chargeable accounting period was where, as we see now emblazoned upon this chapter heading, we were dealing with a long period of account, one of more than 12 months. Because what it means is that from one statement of profit or loss and the appended notes to that, we have to prepare not just one, but two corporate tax computations. How do we do that? We prepare the two computations in order, the first for 12 months, the second the balance of months. So on an 18-month period of account, first computation for 12, the maximum 12 months it can ever be, and the second, the balance, the remaining months, that would be a 6-month period there. Okay, so what we've got to be able to do is to somehow divide the content of the statement of profit or loss, and from it prepare two computations, not just one. So how do we go about that process here, therefore? Well, relatively straightforward rules, sensible rules in the most part, I have to say, which would aid, therefore, your ability to learn this fairly easily. First section, apportioning here income and expenditure. As we've said, if the company has a period of account longer than 12 months, two chargeable accounting periods, first 12 months, then the remaining months. How do we therefore take apart this statement of profit or loss? The income and expenditure is divided between the chargeable accounting periods as follows. Well, your first and major exercises are to do with the, as we know, deriving the tax adjusted trading profit. That comes in two bits, the adjustment of profit statement. So we need to calculate the adjusted trading profit before deducting capital allowances. And we do that adjusted trading profit based on the statement of profit or loss. We make no attempt to divide out the content of that profit or loss between the two periods, not at this point. So, taking the statement of profit or loss, so whether it was 9 months, 12 months, 15, 18 months, we do a normal adjustment of profit process, adding back the non-allowable expenses, taking out any income that isn't trading. So if, for example, you've started from an accounting net profit that has included dividend income, that has included interest income, that has included property income, none of those are trading, and therefore they would be deducted in deriving your adjusted trading profit. So we established the adjusted trading profit for this long period of account. Then, having got the adjusted trading profit for the long period, it is then that we split it between the two chargeable accounting periods. And there's only one logical basis to do that on. we time apportion. So in my example of a moment ago, an 18-month period of account divides into 2 corporate tax computations, 2 chargeable accounting periods, 12 months, 6 months there. So how do we divide out the adjusted trading profit that we've done for the 18-month period? 12/18 to 6/18, the ratio of 12 to 6, a simple time apportionment. When it comes to the capital allowances, easier on one hand, trickier on the other. Easier in as much as we do not prepare a capital allowance computation for a period of account. In corporation tax, we prepare the capital allowance computation for the chargeable accounting period. So our 18-month period split 12 months, 6 months, we have 2 corporate tax computations, we now have 2 capital allowance computations, one for 12 months, one for 6 months. So what you'd have to do is on your list of additions and disposals, usually in chronological order down the page, you'd have to draw a line between what was the last transaction in terms of additions and disposals within the 12-month period, and draw a line, and then what were the additions and disposals, if any, in the second, the short 6-month period. And we do separate capital allowance computations. That therefore may give rise to just a little problem, but not an insurmountable problem. It means that if we're doing that second computation, it's going to be for a short period, something less than 12 months. And what we know is that certain of our capital allowances are based on a 12-month and annual figure. Our AIA limit of 200,000 is per annum. So if we've now got a 6-month period, then the AIA available in that 6-month period is not 200,000, it's only 100,000, 6/12 of that limit. The writing down allowances, your 18% on your main pool, your 8% on your special rate pool there. Those are per annum. So we can only take, therefore, we can only compute 6 months worth of the annual writing down allowances. So be careful there. WDA and AIA will be restricted in the second, the short chargeable accounting period. But of course, note that FYA on low emission cars are never restricted for a short accounting period. The only time apportionments we do, it was true in income tax as is now true in corporate tax, on the annual figures, the AIA, the WDA. First year allowance is a one-off. You bought a low emission car. Whether you buy it in a 12-month period, a 3-month period, or whatever, makes absolutely no difference at all there. You will get the full 100% first year allowance. Now, before we go on to the other items, just to have a quick look at what I mean by that adjusted profit apportionment there. Simple little example. Yeah, I think we've got one. Yeah, here we go. That I wrote out for you before now. It is that the company has prepared its accounts for the 15 months to the 31st of March 17. It's obviously decided to change its accounting date. It's gone from what must here have been a December date to a March date. And it's done it by the preparation of a statement of profit or loss for this 15-month period, and for which the adjusted trading profit was £1 million. So, long period of account, our corporation tax computations, therefore, must be prepared for each chargeable accounting period. It's the 15 months to March 17. That, therefore, would have begun on the 1st of January 16. So our first 12-month period is the 12 months to December 16. That then leaves a balance of a short period, 3 months to March 17. So the way that you present this in your answer, if it's a section C question, of course, here, is in columnar format. So 2 columns on the right-hand side of the page for each of the 2 chargeable accounting periods. The first will always be 12 months, the second there will be the balance of those months. Now, I've given you an adjusted trading profit of 1 million. It is quite possible, of course, in a bigger and better exam question, that they give you the statement of profit or loss, and you have to do your adjustment of profit process, adding back the non-allowable expenses, taking out the non-trading income, and putting 0 in where the item is perfectly allowable for trading purposes there. But that figure here is £1 million, and it now, having been computed for the 15-month period, it now needs to be divided between the two chargeable accounting periods. They are of 12 months and 3 months, therefore 12/15ths and 3/15ths of the 1 million respectively will be allocated here to each of those accounting periods, which if my mental arithmetic is right, 12/15ths, 4/5ths and 3/15ths, 1/5. That therefore is going to be in thousands, 800,000 and £200,000 respectively. So one adjustment of profit statement for whatever is the period of account, normal rules of add backs and deductions, get that figure for the long period, and then time apportion it based on 12 months to whatever length of time the short accounting period may be. Here it was 3 months. We would then deduct our capital allowances. That would be referenced to another working because you would have to do 2 separate capital allowance computations. The first capital allowance computation for the 12 months to December 16. You'd inherited the question, the tax written down values brought forward at the start of that period, the 1st of January 16. Those would kick you off. You'd have already put down on your list of additions and disposals whether it was AIA, whether it was main pool, special rate pool, whether it was WDA, and again, whether it was main or special rate pool, or in terms of cars, whether it was first year allowance. So you would have determined, therefore, what allowances each particular addition was eligible for. Any disposals, again, max sales proceeds to a maximum of original cost. And you'd have drawn a line across the page whereby what were the transactions in the 12 months to December 16, and what then after that were the transactions in the 3 months to March 17. And for each chargeable accounting period, you now prepare a separate capital allowances computation. Remember the problem here, it being a 3-month period, means the AIA Limited would be 3/12ths of the annual figure, so you wouldn't get 200,000, you'd get £50,000. And any writing down allowance will be 3 months worth of what would have been 18% or what would have been 8% there. Okay, now you're going to get a chance to practice that in a short while in terms of the example within this chapter. But that therefore would give you the figure of capital allowances to deduct, whatever they may be. That would give you your tax adjusted trading profit on each of these 2 corporate tax computations. Right, let's go back to the notes now. We've dealt with the adjusted profit, we've dealt with the capital allowances. We've got our tax adjusted trading income figures. So what we need to do now is to bring in any other amounts down to total profits, take out the qualifying charitable donations, get TTP, and then, having got TTP, determine the size of the company in terms of whether or not it's a large company and therefore whether we have to pay the tax on quarterly instalment payment basis or not. But whatever the figures of profit, whatever the dates for the accounting periods, it's a universal rate. It's a 20% tax rate. So the calculation of the tax is ever so easy, 20% of whatever TTP that you get. Right, how do we deal with these other sources of taxable income, being property income and interest income? Property income and accruals basis. Interest receivable, again, working on an accruals basis. So in the 15-month period that we've just had our example on, you would want to know for the 12-month, the first corporate tax computation, what amount of property income, what was the rental income accrued, less the allowable expenses incurred. rental income accrued less allowable expenses incurred. And you would then do a separate computation for the 3-month period, again on an accruals basis. What was the amount accrued in the 3-month period? Now, sometimes, not in fact to trick you or to make life more difficult for you, the information given about either the property income or the interest receivable, both of which work on this accruals basis, they don't give you the accrual figure at the end of the 12-month period. All you can do is to work out the accrued figure, the interest receivable, the rental income accrued for the long period of account. For us, in our example, the 15-month period. If that is the case, having got the accrued figure for the 15-month period, the period of account, then you would time a portion. You would assume that it has accrued evenly. Now, that's only in the case where you don't have any accrual figure at the end of the 12-month period. You've only got it at the end of the 15-month period. Now, that may or may not be a problem. But if that's the case, don't panic if they just tell you the amount receivable there for the 15-month period, the amount of rental income accrued for that 15-month period was this. Just assume it's accrued evenly and split it 12/15 and 3/15 accordingly. But if you've got all the information, then there are two separate corporation tax computations. You want what was the interest receivable in the 12-month period, what was the interest receivable in the 3-month period, what was the rental income accrued in the 12-month, what was the rental income accrued in the 3-month. You do two separate computations if that's possible from the information provided. Now, that brings in your other taxable income, but you've also, of course, got chargeable gains. Very simple basis. You will allocate any disposals of assets in your long period of account between the two chargeable accounting periods based on the date of disposal. So back in our example here of the 12 months to December 16, the 3 months to March 17 there, if you had an asset sold at any date in 2016, the chargeable gain would be included in this, the first of the two computations. If you had a disposal date in January, February, March 17, then the gain would go to the second accounting period. Very simple. You allocate the gains according to the date of disposal. Now, if you put together, therefore, at this point, for each computation, each period, add your trading income assessment to any property income and any interest income assessment, add in any gains, you've now got total profits. Having got total profits, you need to deduct qualifying charitable donations. How do we deduct them? As you would for any individual corporate tax comp based on the date of payment. So again, going back to our earlier example, any donations paid at any date in 2016, well, they are going to get deducted here. That's where they're going to be deducted. Any donations actually paid in the 3 months to March 17, January, February, March of 17, they would get deducted there. So with both gains and donations paid, we're allocating gains on the basis of the date of disposal and the donations based on the date paid. Simple, basic system. Now, having deducted those donations, that of course would bring you down to your TTP. If relevant, it's only going to be relevant if they want you to state when the tax would be payable. Then we've got to add in dividend income to give you, therefore, the profit figure to compare with the relevant profit limit to determine whether the company will just normally pay its tax 9 months and 1 day after the end of the accounting period, or whether it would have to make those payments through the quarterly instalment payment system. To do that, of course, you needed to get profit for that purpose. You needed to add in dividends other than dividends coming in from subsidiary companies related to 51% group companies, and dividends will be brought in on a received basis. What was received in the 12 months, what was received in the 3-month period. but that may well be irrelevant because you don't actually have to state when the tax would be payable. You've simply got to work out the tax liability. So there we go, certain basic simple rules that need here to be applied. Certain simple basic rules to be applied. Now, of course, I've said they're simple. The proof of the pudding, they say, is in the eating, because there we have example 1, where we have to calculate the corporation tax liabilities for the relevant chargeable accounting periods. Now then, we quickly discover that the company A plc has prepared accounts for what is a long period of account, the 15 months to the 30th of June 17. As soon as you see that, you know that in terms of your corporate tax computations, there's going to be a 12-month period and a 3-month period. So that 12-month period will be the 12 months to, well, if it's 15 months to June 17, it would have been the 12 months to the 31st of March 17, followed by 3 months to the 30th of June 17. So you've immediately got the 2 chargeable accounting periods defined. How then do we construct each of these 2 computations? Well, what are we told? Adjusted profit, 4 million. So when it comes to your adjusted profit there, you're going to split that, time apportion 12 to 3, the 4 million divided between it. Now, of course, that's the adjusted profit. It's not the tax-adjusted trading profit. For that, you will need to deduct capital allowances. And for that, you're going to need a working. Because here in the information beneath the numbers stated, they tell us about what's gone on in terms of your additions and disposals of plant and machinery. We're told that the tax written down value of plant and machinery qualifying for capital allowances at the 1st of April 16, the start of this first chargeable accounting period, was nil. So there was nothing in it. Obviously, what's been happening prior to this is that we've been spending on normal plant and machinery and been able to claim 100% AIA. And if we've been buying cars, there have been no emission cars, so we've had 100% first year allowance. So we've ended up with no balances in terms of any main or special rate pool. Now that may or may not be the case. If there was a tax written down value brought forward, you would allocate it to the first of what will now be 2 capital allowance computations to prepare. What's then happened? Capital transactions in plant and machinery during the 15-month period with the purchase of new vans. Now, vans, not cars, vans, lorries, they're trucks. These are not cars and therefore are normal plant and machinery, and therefore you'll get your normal AIA. That was purchased on the 12th of May 16, and therefore it's within that first 12-month period. 68,000, that will be eligible for AIA. And plant and machinery costing 77,500 on April the 14th of 2017. Well, that, of course, between the 1st of April and the 30th of June falls into the second accounting period. Again, that will be eligible for AIA, but be careful. It is a 3-month period, so time apportion the AIA limit. 200,000 for 12 months. So what is it for 3 months? It's only 50,000. 77,500. So you're going to have to limit that AIA for that short 3-month period and then claim, writing down allowance. Writing down allowance, of course, must be time apportioned, because although, again, on that it will be main pool, it'll be 18%, it's only a 3-month period. So it'll only be 3 months worth that you take account of in your capital allowances computation. Now, at this point, what I would like you to do, therefore, is to put together the capital allowance computation for each of the 2 accounting periods. So I'd like you to pause at this particular point in time, because in a few minutes I'll be taking you through that answer. So pause at this point and work out the capital allowances computation. Once you've done those computations, again then come back and I'll take you through those computations to make certain, I hope at least, that you've done it right. Also, of course, you've had to have time apportioned your adjusted profit of 4 million between those two accounting periods. Well, that shouldn't take you very long now, should it? Okay, pause therefore, come back and join us after you've calculated the capital allowances. Okay, well, hopefully, therefore, by now, we've done the two exercises that I've asked of you. That was firstly, make the pen work again. Split the £4 million adjusted trading profit between the two chargeable accounting periods on a time apportionment basis. That was 12 months to 3 months, which hopefully, therefore, has given you the 3.2 million and the £800,000. What we then had to do, and hence here working one, was to prepare two capital allowance computations, one for each chargeable accounting period. The first chargeable accounting period, 12 months to March 17. If there had been any tax written down values brought forward, we'd have started off the computation with them, but here there were none. What we did have was additions that qualified for AIA, here in the form of these vans. £68,000, 68,000 is the amount of AIA available. It's a 12-month period, so we've got the £200,000 limit, so the allowances go in there. That therefore was the only allowance, as there was no residue over 200 for writing down allowance, there was no tax written down value brought forward, therefore no writing down allowance, and there were no low emission cars purchased. There's nothing else, it's just AIA. And hence therefore the £68,000 capital allowance that goes in to your corporate tax computation for the 12 months to March 17. On then to the 3 months to June 17, slightly more interesting in as much as, again, you've got plant and machinery that is addition qualifying for AIA. The amount is 77,500, but as we made reference to before you did it, the AIA is only £50,000 because it's a 3-month period. So the 50,000 goes into your allowances column, leaving £27,500 to go to the main pool. What do we get to claim on main pool in the form of a writing down allowance? It's 18%. But the length of this accounting period is only 3 months, so it's times 3/12. Put the calculation through your calculator. Hopefully, it's that number that we see there, but check it out just to make certain. But it's 18% of 27,500 times 3/12. What's the figure? Hopefully 1,238. Add it to the 50,000, and there you've got the capital allowances for the second accounting period there, which, as I look at that figure, doesn't appear to be the right number. So in which case, therefore, that should be 51,238. So just make sure, hopefully by the time you look at this, when you're doing it, that figure will have been amended, but my apologies for the typo, haven't updated, taken out the number from the previous year. But that figure there, as you can see, should be £51,238. We'll take it away, and that will give you the revised tax adjusted trading profit. But there were a couple of other transactions that we needed to deal with. Let's go and look at those now. So let's just go back. Here we go to the information, the question, and you've got a chargeable gain. That chargeable gain, how do we determine which accounting period it will be allocated to? Very simple, based on the date of disposal. The asset was sold on the 6th of May 17. Therefore, in which accounting period does that fall? Now, this was the 15-month period to June 17. Chargeable accounting periods, 12 months to March 17, no. 3 months to June 17, yes. So your chargeable gain, therefore, how much was the figure? £80,000. it will go into the 3-month period. Finally, qualifying charitable donations. Paid, we want the paid date. It's annually on the 31st of July. So in that 15-month period, in the 12 months to March 17, do we have a 31st of July? Yes, we do. So the £20,000 was paid there. So when you deduct, obviously you'll be deducting the qualifying charitable donations from your total profit to derive your TTP. You've allocated these two transactions to the relevant chargeable accounting period based on the date of the transaction. The gains, the date of disposal, the donations, the date when they were paid. Back to our answers now, and we see the gain going into the short period. We can see the donation going into the first of these two periods. Establish then what the taxable total profits will be. Now that figure obviously will need to be amended because of the difference in capital allowances there. But once done, whatever the figures of profits, corporation tax at our single universal rate of 20% will be charged. So hopefully for most of you, when you look at this, it will be the amended figure. But my apologies for the updating error there. Okay, so on that basis, we're now able to take our statement of profit or loss, whether it be for a short period, whether it be for a 12-month period, whether it be for a long period of account, and from that one statement of profit or loss, prepare either one or maximum there two corporate tax computations therefrom. Whatever figure of TTP we derive at the bottom of that computation, 20% will be the corporate tax rate. What we'll look at in a later chapter on the administration, as we've already flagged so many times, is about when we pay the tax and whether the quarter instalment payments system will be relevant for the company for the period concerned. That brings to a close this particular chapter, you'll be pleased to hear. In our next chapter together, we'll look at what we had to do in income tax as well. Whenever a business is operated, we hope we'll make an adjusted trading profit, but there's no guarantee. So what happens therefore if sadly we have a tax adjusted trading loss? So it's corporate tax losses therefore that await us in our next chapter. Again, as ever, I look forward to seeing you then.